Hello, everybody. This is Scott Hutzbeth, Agent Mastermind. Welcome to the call. It's Tuesday, 12 noon, and I have a very special guest for us today. We always talk about making more money, getting more leads, getting more referrals, all this kind of stuff. But we have never, in the 2 years and 2.5 years we've been doing this, have never talked about how to save our money or how to keep the money that we're making. So I have a dear friend, special guest, Vern Motor, who is a tax strategist, and I'm gonna let him tell you about himself. But welcome to the call, Vern.
Hey, thanks, Scott.
I appreciate you being here. So, this screen kind of says it all: how to save up to 50,000 on your income taxes every year. And right now, everybody's probably getting the old dreaded tax return and how much do I owe, and hopefully it's not that way. Hopefully it's how much am I getting back. But for most of us self-employed borrowers, the dot coms of us, we find ourselves paying in money. And you're going to give us some strategies on how to keep some more of that money. Is that right?
Yeah, absolutely. I've been a CPA over 18 years, and all CPAs, just like all real estate agents and brokers, are not created equal. So there's some that just kind of fill out the forms, and then there's others of us that say, "Hey, let's figure out some strategies to really save you some money." I actually wrote a book called "Keep Your Money." That's what it's all about: how to save five to $50,000 on your taxes every year. So we're going to talk about the upper end of that today.
Let's do it. You know what? Let's jump right in, and I got my pad and paper, and I'm gonna take notes. And I got a couple guys that are on the call that said, "Hey, when are you doing that?" So really looking forward to hear what you have for us.
Okay, so perfect. So I would recommend everybody just grab a quick notepad. We are going to go fast. There's a lot of stuff I just want to pile on you, and we only have an hour. So I just want to show you a couple of core strategies. My promise to you will be this. Look, I'm not going to waste your time, okay? That's our most valuable asset. We all know we can't get that back. What I am going to make sure we do is let me see if I can get the Scott. There we go. I'm going to talk about two core strategies, okay? But out of those core strategies, you're going to learn probably 6 to 8 nuggets that you can take with you. And each of those nuggets, some of them may work for you, some of them may not, but they're going to be save you thousands of dollars each. And then the two core strategies will save you close to $50,000 each strategy. So I'm not going to waste your time. We're going to go pretty quick. But I want to show set the stage a little bit. Now, $1 billion, what's that got to do with everything? Well, you've all seen the H&R Block commercials, right? Where the guy is putting money back on the stadium seats, and now you got the one where he's dancing to Reunited, looking like the gopher on Caddyshack. That stuff's true. We pay over $1 billion to Uncle Sam every single year. And it's not just people that pay their or do their own taxes. A lot of it's people who use a preparer that just doesn't strategize for them. So that's a lot of money, and the strategy here is let's keep what's ours. So here's a simple question. Who's a better steward of your money, you or Uncle Sam, right? I'm not sure about you, but every time I write a check or one of my clients write a check to Uncle Sam, I feel like enabling this spending addict. I don't care what side of the aisle you're on, what your political beliefs are. That's nothing about this. It's just who's a better steward of your money? And from that comes a question, what do you really want? And usually when I ask that question, I get, oh, I want happiness, or I want fulfillment, or all of this stuff. Well, I was with Carl and Scott at a seminar not long ago where we got to hear Mr. Wonderful from Shark Tank, right? Kevin O'Leary speak. And he said, what do people really want? And what he came up with, I mean, you either love Kevin or you hate him, right? He's a definitely polarizing figure. And he said, what is it that people really want? Well, they want freedom, right? Freedom to do what you want, when you want, not just time freedom, but financial freedom, spiritual freedom, all of that, right? Physical freedom. How do you get that freedom? And he went on to say that, look, wealth equals freedom because having that wealth buys you time, buys you everything else you need. It gives you that freedom. So if wealth equals freedom, then what I'm going to say is that wealth is created in the margins. Scott and Carl, you guys do a great job about, hey, let's make as much as we can, put as much to the top line as possible. We need to focus on that. The second part is we need to keep everything that we make. The more we keep, the better off we're going to be. So let's dive into some strategies, okay? I hope you have your notepads ready. The first one I call is the C Corp strategy. And so stay with me on this. The C Corp strategy is something that we're going to use. This strategy in itself, with all the things about it, is going to save you a ton of money. So backing up though, what do most people do? Well, most people first set up their business as a sole
SSGO. Yeah,
proprietorship,
right, right.
you know? So they set it up as a sole proprietorship. And why do they do that? Because it's easy, right? But because it's easy, Uncle Sam's made it easy. That's how you pay the highest taxes. There's no liability protection. I'm probably telling you some stuff you already know. I just want you to get a basis for this. And then the next step is they say, oh, I'm going to set up an LLC. Well, I love LLCs, right? But the thing about an LLC is it gives you liability protection. I love LLCs, though, because they're flexible. But unless you use the flexibility of an LLC, you get zero tax savings. No tax savings unless you set it up as an S Corp or a C Corp. LLCs are great for investment in real estate. Well, let's take a quick, I'm going to switch over here to a little screen so I can draw an example for you of what the tax situation for a sole proprietorship would look like. So I'm just going to draw a bucket here. I used to draw circles, and then this state attorney said you can't put anything in a circle, Vern. It has to be a bucket. So this is our sole proprietorship, or an LLC without um, electing any other tax coverage. And I'm just going to say, hey, we're going to use $300,000. That's our bottom line number. Some of you might make more than that. Some of you might make less than that. It doesn't really matter. $300,000, and that's going to just keep our whole scenario the same so you can see the illustration. So on $300,000 of bottom line income, we're going to pay self-employment taxes on $117,000 of that. What's self-employment tax? That's Social Security and Medicare. You actually pay Medicare on the whole amount, but the Social Security taxes on that are $18,000. We haven't even started talking about income yet, right? The Medicare additional is $5,300. So before we even get out the door, we're at $23,300 in tax. Wow, boom. That's just Social Security. We haven't even gotten to income tax yet. So I'm going to say we're going to take a standard deduction. What that means is that's the one Uncle Sam gives you, right? Now, most of you probably own your own home and give some contributions charitably and itemize. But again, so we can keep the illustrations the same, I'm just going to use the same numbers. So if you take the standard deduction, and I'm going to say you have a couple of kids, exemption-wise and all of that, basically we're going to take off $22,000. We get a deduction for half of this. So our deductions basically are 22. So we're going to still pay tax on $278,000, okay? That's kind of our base number. The income tax on that is $65,700. Plus we add our 23.3, $89,000. And that's just Fed. Now I don't know where you live, but I live in California. And we have one of the highest income tax rates out there, right? You get up to 13.3 maximum, and you graduates up through that. But a lot of people are paying 6 to 10%. If you're fortunate enough to live in one of those tax-free states, God bless you. But if you're
Okay, okay.
not,
What is one of them tax-free states? Yeah.
oh, let's talk. You
No,
want to
I'm
talk
just
about
kidding. I'm
tax-free
just kidding.
states?
I'm just kidding.
Yeah.
Texas.
Actually, we'll talk about a few when we get later into
All
our
right.
strategy on where you set up your corporation, because there are a few that have no state income tax. I shouldn't say tax-free, but
Okay.
no
All right.
state income
All right.
tax. So $89,000. I mean, that's the minimum, okay, that you're going to pay here. Set up as a sole proprietor, or if you talk to your buddy down the street who said, hey, you need to have an LLC and you don't have it taxed as one of the other entities, that's where you're at. That's a lot of money. Let's go back over to the slides. Okay, so an LLC, I'm sure you guys love those as far as holding property, and I do too. But if you're going to use the flexibility of an LLC, you want to have it taxed as an S Corp or a C Corp. So let's talk about an S corporation. Now, this is what most people do, right? If you have one, great. I'm not knocking you at all, because I love S corporations. I just like S corporations in conjunction with the C Corp strategy that we're going to talk about. So S corps are what a lot of people do, right? That's what a lot of accountants tell people to do. It's what a lot of attorneys tell people to do. The nice thing about an S corp is you get to save some of that self-employment tax, right? That 18,000 plus the Medicare, the 23,000 in our last scenario, you get to save some of that. You don't have to pay as much. So you don't have to pay self-employment tax on all your income. That's why people like them. You do have some liability protection. People like that as well. The challenge is that S corporations lost most of their really, really good tax advantages in 1986. Now, I'm not knocking my profession. I will agree that there's many of us in our profession, my profession, that are slow to change. Maybe there's some real estate agents like that too that you know, okay? But most CPAs haven't really latched onto the fact that S corp tax advantages just aren't what they used to be and haven't been for quite some time. But let's talk about how they work. An S corp, if you don't know, it pays, the owners pay the tax on it, so it flows through. Not only does the income flow through, but many of the individual items like health insurance, contributions, things like that, they flow through separately to you too. So you're actually still paying all that tax based on your personal income tax rates. And I'm going to switch back over here and we're going to walk through a little S corp strategy.
Vern, one of the questions
Get rid of
coming in,
that one.
one of the questions coming in is, I kind of had this too. What if, and you may be going to talk about this at the end of this presentation, but what if I have more questions? What if I'm not sure after taking on my notes, if like where I should go? You're being the strategist. Do you have anything for us at the end? I don't know if you're going to cover that or not, but
Yeah.
I just
Yeah.
because I
Hey, thanks for covering that because
yeah.
here's what I'm going to do is I'm going to do a Q&A at the end
Okay,
and then
cool,
I'll give you a
good, good,
website and I'll
good.
give you my email.
Okay,
And
awesome.
so
Thank you.
yeah,
Because I could
I,
see that you and I
yeah,
need
I'm
to
going
talk.
fast. I
Yeah,
know I
I
am.
could see that. Yeah, 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 for sure. Thank you.
I want you guys to get some concepts. So let's talk about the S corp. Here's our bucket again, right? Boom, boom, boom. Now we're in S
I want to know
corp.
what you're drawing with too. This is pretty cool.
Isn't that cool? It's called a
Yeah.
bamboo.
Okay. Okay. All right.
Okay, so 300,000, same income, right? That's our bottom line. Now, in order to save that self-employment tax, Uncle Sam says you have to pay yourself a reasonable wage. Well, what the heck is reasonable, right? They don't know what reasonable is, but we're just going to assume that it's 50,000. All right. So we're going to pay ourselves a wage of 50 and we're going to have 250 left over, right? So on this wage, we have to pay the self-employment taxes, the FICA and the Medicare, and there's a few others. But basically, to keep it simple, that's 7,650 bucks. Now, we're not paying self-employment tax, so we don't get to deduct as much on our personal tax return. So when we get down to our personal tax return, we're going to pay tax on 250 of income plus 50,000. So we're still paying tax, right, on 300, just like in our other scenario. We're going to have some tax deductions as far as the standard deduction and all of that, which equal $28,000. Okay. So we've got basically our tax on that's 7650 plus 71,300 income tax because we don't get some of the deductions. That's the difference between that and the 67,000 that we had in the last scenario is you don't get to deduct half your self-employment tax because we're not paying it, which is better, right? So now we're at $79,000 in tax. Now that's 79 versus, oh, that's bad, isn't it? You can tell that I'm an accountant, not an artist, right? So that's $10,000 worth of savings off
Just
of
right there.
our original strategy, right? Which is good. Don't get me wrong. That's awesome. But I think you guys are thinking, hey, you said $50,000. So what's a better strategy? So this is where I said, let's use it in conjunction with something else. So if we go back to our slides, let's talk about the C Corp. Now here's the advantages of a C Corp, and I want you to write these down. The benefits is it pays its own tax. You might be thinking, well, wait a minute, I thought we were talking about not paying tax. But a C Corp, I'm going to talk about in a minute, has its own brackets. So it takes income off of your personal return and puts it on the C Corp return. And we talked about the S Corp that lost all those tax advantages, or a lot of them back in 1986. Well, the C Corporation didn't. So it has a lot more and better deductions that get to save you a ton of money. So when we talk about paying its own tax, it has separate tax brackets. So the first $50,000 of bottom line income only gets taxed at 15%. Now, I didn't write it down, but back in the sole proprietorship or the S Corp strategy, standalones, we're at the 33% tax bracket, and that's just federal. So any money that we can move from that tax bracket down into 15 saves us a ton of cash, right? And then if you add state on that, I'm going to give you some strategies for having your C Corp in a state that doesn't have state income tax. You can save a ton. Well, the next 25,000 is taxed at 25%, and then you're taxed at 31% on the next 25,000. Then it goes up to 33 and back down to 31. So we just want to talk about shifting some of these lower incomes. So it pays its own tax. That's actually an advantage. So the strategy here is really how much income can I shift off my personal out of the high 33% plus state over into the 15 or maybe 25 and maybe no state. So let's kind of walk through that scenario, okay? And I know I'm going super fast, y'all.
No, but you're getting me
Just
excited
bear
though. I
with
mean, this
me.
is a big deal because man, I tell you, if you know, there's a lot of people on this call, and if you're making good money, the last thing we want to do is have to pay it all in taxes. So, I mean, I love this. I mean, I don't know if anybody else is enjoying this, but I mean, I would rather keep my money than give it to the government. So, I appreciate you being here, man.
Oh, yeah, absolutely. So, okay, I told you I like to use an S Corp and a C Corp in conjunction. You can also use a sole proprietorship and a C Corp in conjunction. You just don't get quite as much bang for your buck. So let's go back over here to my fantastic artistic abilities. And we're going to say this is our S. Okay? We've moved past the old sole proprietor paying all that self-employment tax. We've gone over to an S. Then over here, we're going to have our C, which we're going to just set up brand new if you don't have one already. Okay? Now, again, we want to shift income from here to here. So on our S Corp, we're still making 300, just like we did before. But how many of you need to do marketing or something like that? Or how many of you maybe need somebody else or some other entity maybe to help manage what you got going on? We're going to use
Yep.
marketing because it's an easy example. Let's just say we're going to pay a marketing fee or a marketing company $150,000.
Do you need my name on this, Vern? I mean, to
It's going to
like,
go over.
yeah.
Yeah, yeah. You're going to be the marketing
Yeah, I'm
company.
gonna be the
Scott's our
market.
marketing
Yeah.
company.
Okay,
So
okay,
you get
cool.
to pay yourself.
I'm liking this. Good.
You get to pay yourself $150,000. Keep the numbers and the math fairly easy. We're going to pay that over to our C Corp, right? As a marketing fee. They're going to do some work, and I know you guys pay some other expenses out of there. We're going to shift some of that over to another entity. It could be marketing, it could be anything else. We can talk about that, and I love to strategize with people, figure out what's right for their business. So anyway, so we still have to pay a reasonable salary, right? So instead of paying 50, we're going to pay 25 over here, and we're going to pay 25 over here, just to keep it all even, right? So now we've got 125,000 of income here. We've got 50. This is your personal tax return. We've got 50 because you're going to be making wages on both salaries, right? But our C Corp, our bottom line income is now 125. Okay? Our S Corp, our bottom line income is 150 plus the 25 plus the 25 from over here. So now we're paying tax, or our income on our personal returns only 175. Now, not only is that a big deal, but what you've done is you've brought yourself down out of those higher tax brackets into a lower tax bracket. That's huge. Okay. Why is it huge? Well, first of all, there's an additional tax that we haven't even talked about now that's everybody's been calling the Obamacare tax, right? It's really the net investment income tax, NII. If you're single, you pay that on any of your investment income once you've reached $200,000. If you're married, it's 250,000. So now that tax, that Obamacare tax, that's 4.8% over and above the top rate of 39. Okay, and that's before state taxes. So I mean, we're getting into huge tax brackets once you get over 200 or 250,000. So it's brought you down out of that. So now you're not going to be subject to some of those additional taxes. So the tax on that 175, we free up some exemptions, right? So if you have kids and all of that, standard deduction, no limit. So now it's 28. So now we're paying tax on 147. Okay. And the tax on that's 22K. All right. So let's just write that up here. That's 22,000. All right. Now on a corp, we get to go through the brackets. And so on the first part, it's 7650. Then the next bracket's 6250. And on the balance, I think it's like 7750. So we're like at 21.5 in tax. So let's add that over here. 21.5 in tax. Then we had to pay the same self-employment tax, right? The 7650 that we've been paying on our salary. So we have to add that in. We're at 7650, but all that comes up to 51,150. Wow, right?
That's
Now we're
about
getting somewhere.
if I remember right, that's about 20 grand less.
It's 37,850
37,000.
less than the sole proprietor and 27,850 less than our S corp, right?
Wow. Wow, yeah.
That's
Yeah.
huge.
Huge.
Now,
Amazing.
and
Amazing.
and all we've done here is shifted some income over to a lower tax bracket. We haven't even gotten to the sexy stuff yet, right? So this is just a simple strategy of moving some income off your personal return out of high tax brackets into a lower tax bracket. That's not 50,000. I told you you're going to save 50,000. I'm going to say that's 27 or 37,000. So
Just
let's go
doing that.
back over and talk about some of those other strategies. So back over to the slideshow. So shifting brackets. Here's some other income shifting strategies. Okay, when I go to church on Sunday, and what my pastor says is he adds an extra verse or something in, a little new scripture. He says, no charge for that. That's free, right? He makes me laugh every time he says it. So I'm going to say that right here. No charge for this. This is extra stuff. You don't need a C Corp to do this, although it helps. I'll tell you why. But what about paying your kids? Have you ever thought of that as a tax strategy? Maybe you have, maybe you haven't, but I don't know about you. I've got 3 kids, and when they come home from school, it seems like I can just follow the trail all the way to their bedroom till they change their play clothes, right? You got socks, you got shoes, you're stepping over all this stuff, and if it's not clothes, it's toys. Wonder if we could trick them into picking all that up if we paid them. Did you know you can pay your kids, each kid, $6,200 each year? Okay, so that's a little over $500 a month. That's a pretty good allowance. But you can pay them to work in your business, no matter what it is. Maybe they're cleaning the office, maybe they're filing, whatever it is. It doesn't take much to get to $500 a month. You pay your kids on that first $6,200 of income that you pay them. You know what they pay in tax?
15%.
Zero.
Zero? Really?
0%.
What?
Yeah. So the first income tax bracket, because our individual taxes are graduated, the first income tax bracket zero, right? So up to $6,200, that's their standard deduction. So they pay
Wow.
zero tax. So now if you've
Wow.
got 2 kids, little over 12 grand you pay them in salary, and boom, you just took that from 33 or 39 or whatever marginal rate you're in, and you've taken that to zero. How cool is that,
I know we're
right?
supposed to wait for Q&A, but do they have to physically do something for my company?
It has to be reasonable, but the
Okay.
IRS is not in your business every single day. Now, I've had people pay their kids before they were 5, and you can justify
Okay.
it. Some
Okay.
people use their kids in marketing, which is a great thing. You take
Sure.
pictures of your kids. I've
Sure.
seen guys on stage do that, and then
Yep.
you pay your kids every time you show their photo. That's all legit, right?
Okay.
So you just have to come up with a
Huh.
true business purpose. And the other
Wow.
thing is, Scott, is document it. The more you document,
Absolutely.
the better off you are.
Run
So
errands
that's a
for me,
strategy. But
run
if
errands for me, or do you pick up this, pick up that. I mean, whatever, right? I mean, it could be
Absolutely
anything.
organize my office,
Or
clean the
yeah, right,
office,
right,
pick up that broom, Johnny.
right.
It's time for you and me to both make some
Yeah,
money.
yeah.
So let's just assume it's like 40% federal and state. I mean, you're saving $3,000 or $4,000 depending on what you're paying your kids. The other thing we didn't talk about is the fiscal year end. You know what? This is important. So I'm going to switch back over here and I'm going to delete this and just draw this out quickly. So here's our S Corp that we were talking about, right? And your individual. The end of your tax year, generally speaking, an S Corp can only have one other tax year, and I've only seen one in my entire over 18-year career that fiscal year end. But typically it's 12/31. We're just going to say it's 12/31/13. Okay. Your personal return, right? Your calendar year ends 12. The power of a C corp is that we get to have a fiscal year end. Now you might be saying, well, what does that mean? That means we get to pick our tax year. It doesn't have to be on a calendar year. So depending on if you're shifting income to your C corp, or in some cases you're shifting income from your C corp, you choose the best fiscal year end. So on that money, all that tax we said we had to pay, our calendar year ends 12/31. That means we have to pay our taxes by what? 4/15/14, right?
Yep.
It's coming up a week
Next week,
away.
baby. Yep.
But if we're shifting income from our S corp or our personal return over to our fiscal year end C corp, and let's just say it has a year end of November 30th, okay?
Ooh.
13. And in December, the last month of this tax year, we make that payment of $150,000. When does that tax have to be paid? Well, it came over in December, which means it's in the first month, right,
Right.
of our tax year. That means we go all the way till 11/30 of 14, and then we file our tax return 3 months later, which is February 15th of 15.
A year
So think
later.
about that.
Wow.
See that time difference? Do I want to pay my taxes here or do I want to pay my taxes here?
Why we're earning
Right?
interest on the 150 is what you're saying. I'm sure you're going to show us how to do that, or you have some ideas for that as
Absolutely.
well.
So,
Yeah.
and I'm not going to go into the details of that, but even if you left it in a savings account and
No
made a half a
question.
point or whatever
No
it is,
question.
you'd be money ahead. But what if you're making 10 or 15% on some rental properties that you buy and stuff like that? Wouldn't that be an advantageous tool to be able to
Oh
defer that
man.
tax
No
for that
question.
period of time?
No question.
I mean,
Wow.
oh,
Well, if
okay. So you can see I
yeah,
get a little excited about
yeah,
this stuff.
my head's spinning a little bit right now too. So I'm gonna keep my mouth shut here.
Yeah, I know we're going through it fast, but
Yeah.
there will be time for questions. I guarantee it.
Okay.
So now let's talk about those more deductions, right? And better deductions. I told you the S corp lost a lot of them. Now I'm not really a code section freak. I'm more of a non-code section freak when it comes to tax law and all of that. But I have to show you the code sections because inevitably, here's what you'll do. You're going to go to your CPA or your tax preparer, and you're going to say, "Hey, I listened to this guy, and he said that I could deduct 100% of my medical." And your CPA is going to look at you like, "What?" And he's going to say, "Well, I'm going to have to research that." And really, what that means for you is that you have to pay for his education. And so I'm going to tell you exactly where these code sections are, and you can just jot them down. So medical deductions, let's talk about that. Now, we all know health insurance, right? I don't know what plan you're on, but we all know it's going up. That's the bottom line. And I don't know what you pay or anything like that, but let's just say it's $1,000 a month, and that's probably pretty lean. So that's 12 grand a year, and let's say we've got some out-of-pocket prescription, whatever. Let's just use $20,000 for a round number. If you typically right now you claim that on Schedule A of your personal return, it's called an itemized deduction. Except the challenge to that is the tax law says that you have to exclude the first 10% of that. So if you're making 300 grand, the first 30,000 is excluded. You only get what's over 30. Boom, $20,000 of deductions, poof, out the window, right? If you do that through your S corp, same thing. It flows through separately, poof, pretty much gone. You can take a little bit, you get to take half of your health insurance on the front page of self-employed health insurance. But other than that, poof, that's $20,000 deductions gone. In a C corp, you get 100% of that deduction. 100%. of medical expenses can cover the employees, which is you, right? In your C Corp, 100% deductible. Boom. So now we just took $20,000 or thereabouts and brought it from losing a deduction into having a deduction. How cool is that? Again, at the higher tax brackets, that's $4,000 or $5,000 just in medical deductions that you're saving by having that C Corp. All right. Here's another one. This one's okay. I think I told you all this stuff. 10% deduction, AGI limitation, Corp's got 100%. Section 74 is called awards. Now, this isn't that sexy as far as tax savings, but it's pretty doggone fun. So here's the bottom line, that you can pay yourself an award every year out of your C Corp. Now, if you pay it in cash, it's $400. It's hard to get excited about $400. But if it's non-cash, it could be $1,600. And say maybe you're there the longest. There's a longevity award or a safety award for not getting a paper cut, whatever it is. It's kind of silly, but the reality is if you paid your wife an award or your spouse an award, what could you do? $1,600. Now that's a pretty nice little weekend vacation, right? That can be all 100% deductible through the corporation that you don't have to pay tax on individually. I know it's kind of silly, but it's kind of fun, right? Just a little way to reward yourself and let Uncle Sam pay for it. Now here's another one. A lot of people with kids, they have dependent care. So this is section 129. Now on dependent care, you get a credit on your personal return. But if you're making a bunch of money like we're talking about in our scenarios, all of that's limited out. You get no benefit for your dependent care, no deduction, no credit. Okay? Through a C corporation, there's no AGI limit. It's 100% deductible. So if you're paying $5, 6, 10, $12,000 a year in dependent care for your kids, you pay that through a C corp, 100% deductible. Again, that's not gonna put you into retirement, but that's $3, 4, $5,000 a year that you're getting that you're not getting now if you're in the other scenario. So it's pretty cool. Section 127, education. You might be thinking, okay, what's education? Well, remember we talked about paying the kids? Well, maybe your kids are in a private school, right? Maybe that private school has tuition. You can pay $5,250 per year per employee in just additional education expense. Now, that might not cover your private school. It might not cover college. Maybe it will. I don't know where your kids are going. But right there, that's fully deductible out of your C Corp, where you don't get benefits for all of those deductions, especially non-college education. You don't get benefits for that as an individual or through your S Corp, right? Here you get 100% deduction for it. And if you're paying your kids, sweet. Now we're getting to be able to deduct their private school or their college, and we get them to pick up the clothes, right? Okay. Section 132, physical fitness center. You're thinking, gosh, Vern, what does this have to do with anything? I don't know about you, but we could all probably lose. I'm in pretty good shape. Okay. You don't know that. You don't know if I'm kidding you, but I'm in pretty good shape. But don't we all think we could be in a little better shape? How many of you like to go to the gym, or maybe I should say like gym fees, membership fees like that? They're not deductible through an S Corp or on your personal. Okay. A C Corp can actually set up an entire physical fitness center. Maybe you have a home office, and I'm shaking my head, yes, you should have a home office. If you have a home office for your C corporation and you set up a physical fitness center in your house, 100% deductible, right? So let's get America thin, let's get America in shape. 100% deductible. That's pretty cool. Cafeteria plan, section 125. Now the concept behind this is real simple, and you can use these not just in a C Corp, but you can use these in an S Corp and a sole proprietor too. We use a company called BizPlan or AgriPlan if you have any farm-related activities, but bizplan.com I think will get you there. Section 170 or 125 basically says, let me pay for a lot of that stuff that I pay for anyway with pre-tax dollars. So you get a tax deduction and then your plan pays for it. Super easy to set up and administer. That's just kind of one of those things I think that'll help you out, save you a few $1,000s a year. It's pretty cool. Now, I talked to you about Kevin O'Leary and listening to him speak. One of the things he said is, I'm only investing in stuff that gives me cash now. So when he looks for a company, he's looking for a company that's going to pay him cash, dividends, right? Let's just say, and I know I like to invest in real estate. I also like to invest a little bit in the market. I like real estate more. But the stuff that kicks off a dividend from the market, I'm paying tax on that. And now the tax benefits of having dividends, capital gains rates are gone. So if I had $10,000 worth of dividends, that's going to be at my top bracket, right? 25, 33, 39, and it's also subject to that Obamacare tax. So I mean, I could be paying a lot of tax on those dividends. If you own those stocks that pay those dividends inside your C corp, you get to exclude 70 to 80% of the income depending on how much the company you own. Now that's huge. That's just basically boom, $10,000. Oh, I don't have to pay any tax on 7,000 of it. How cool is that, right? Or 88,000 dollars of it if I own more of the company. So cool stuff right there. That's something a C corp has. Nobody else has.
This is really good stuff, man. I just got to say that I'm getting really excited about this.
So the state taxes, right? I told you, if you live in a high income tax state, this is where it gets sexy. So you get to pick your venue with the C Corp. Now, your corporation does not have to be in the same location that your business is right now. You'll find that my corporation's set up in Wyoming. You might be thinking, oh, gosh, why Wyoming? Where is that anyway? Well, it's a tax-free state and it has a lot of privacy laws just like Nevada does. I'm sure you've heard of the Nevada Corp, right? They're very, very popular, especially with a lot of folks here in California. But the reality is there's a lot of states that do this. Texas is one of them. Um, Florida is one of them. Wyoming, uh, Nevada, and there's a couple others that don't have state taxes, state income taxes. So if I set my corporation up and I'm shifting income there, let's just use California for an example. And let's just say I'm in the 10%, maybe not the top 13% bracket. That means out of that $150,000, remember that I shifted over to my C corporation, I just saved an additional $15,000 in tax by not paying state tax on that money. So now that 37,000 or 27,000 that we saved just by having my entity in a separate state saved me another 15 grand. Now we are up to 50, right? The C Corp also has liability protection similar to the S Corp, all of that. So I think you're kind of getting the concept here that, wow, bam, a C Corp can really save me a lot of money. And now you're thinking, okay, why doesn't everybody do this, right? Why isn't everybody doing this? Well, there's a couple of reasons. And first is a lot of Russian still haven't made changes, right? They like S Corps, they understand S Corps, they're easy for, and they think this is super complex. Those are the myths. It's complicated and there's double taxation. Well, having a C Corp is no more complicated than having an S Corp or an LLC or anything else. So let's just dispel that right now. And the whole double taxation thing, you'll hear that on the street. Oh, you don't want a C Corp because they get double taxed. Let me tell you exactly what double taxation in a C Corp is. It's when the corporation pays a dividend to the shareholder. The corporation does not take a tax deduction, and the shareholder has to report that dividend as income. Now we're talking double tax, right? Absolutely. Is double taxation a reality? Absolutely. But here's the thing. Dividends in a small corporation like we're talking about is the worst way to take money out of a C corporation. So why do you do that? And all of my clients, very, very few ever take a dividend out of their corporation. They get cash out in other means because we have all these other deductions that we can take, and we only touch the surface on that. So if you wanted to pay this, I call it the stupid tax, you would pay a dividend, right? And get double taxation. But if you don't, there's other ways to do it. So those are total myths. You might be saying, okay, this is simple, Vern. You're telling me it's simple. How do I implement it? I'm going to give you these steps real quickly. You choose a venue. That means a state. Do you want it in your high tax state? Or if you already live in a tax-free state, I would recommend just having it in your state, right? And when I say tax-free, no, I'm saying income tax-free, right? I like Wyoming for a couple of reasons. It's cheap. It cost me a couple of $100s to set up a corporation. It cost me $100 a year, right? You can't go out for dinner for that. Sometimes lunch costs more than that. $100 a year to run your C Corp out of Wyoming. That's why I like it. You file articles of incorporation. Now you can do that in most states on your own, or like I said, in Wyoming, $200. I'll tell you the attorney. He'll set it up for you, and boom, you're up and in business. You choose your fiscal year end. You say, is money going into my corp, or is money going to come out of my corp? And typically, the scenario we've talked about today, money's going into your corp. So we're going to choose a year end, maybe around November. You create bylaws. I usually have an attorney do this. We have bylaws. We help people with that. You create your bylaws. All that is, it says this is what how my company's going to operate. Here's what the president's going to do, the vice president, yada, yada, yada. So then you get an ID number. You go get a bank account, and you're in business. Okay? How about that? So there's a bunch of nuggets right there in that strategy, and there's a strategy that saves you at least $50,000, and we're only partway through. So I'm going to talk to you real quickly about a second core strategy because I want to save a ton of
You
time for
mean no? Wait,
questions. Okay?
you have more? Seriously, you have more than that?
I do.
These
I hope.
folks. Okay, man. No,
I
this
hope
is good.
nobody's
This
going
is
to
good.
explode.
No, my head's exploding right now. So no, keep going, man. This is good.
Okay, so here's the other thing people always talk about. Excuse me, retirement plans, right? Hold on one second for me. Oh, sorry. I hope that had a cough. Didn't want to cough in your ear.
All good,
Okay,
man.
so retirement plans. Let's talk about them because they're a great strategy. I call this the retirement plan strategy. That's pretty creative, isn't it? Okay, so most people are familiar with retirement plans that are called defined contribution, right? Everybody knows them. We've talked about them. I don't care what your feelings are about them. You got your traditional IRA, Roth IRA, simple SEP, KEO if you've been around long enough to see those, 401k, Roth 401k, solo 401k, this okay, this, you right, on and on and on. So you have all these, and they're based on one thing. How much can I put into the plan? How much can I contribute? And I'm using my little quotation fingers, right? How much can I contribute? That's based on your deduction. And to make all this simple, what you're seeing here on the screen, if it says Roth in front of it, you don't get a tax deduction, but you don't pay tax when you pull it out. If it doesn't say Roth, you get a tax deduction for it this year, but you pay tax on everything when you pull it out, okay? Real simple. But this is what everybody else is doing. And you've probably heard, right? If you want to know what to do, look at what everybody else is doing and do the opposite, right? So these are contributions, limited deductions. You're probably not going to achieve your financial wealth goals putting $5,500 into your IRA. And I'm not saying it's not a good idea. Don't do it. Don't get me wrong. Or $6,500 if you're over 50. It's just that your hands are tied, right? In a 401k, the max contribution is $40,000. That's pretty good. You know, Uncle Sam's paying $16,000 of that based on like a 40% tax rate. But can we do better? Absolutely. Here's what I love is when the old becomes hip again, right? I'm still waiting when I can roll my jeans. I mean, I still do it, but people look at me funny because it's not the 80s anymore, right? Maybe parachute pants will come back. But here's an old plan. It's called a defined benefit plan. You get the distinction there? Defined contribution, what you put in. Defined benefit, what it pays you. Okay? These have been around forever. This is the old retirement plan where you used to work for a company for 40 years and they pay you a pension, right? A pension, and maybe you get a gold watch, whatever. But that
Woohoo!
was a defined benefit. It said, this is what I'm going to pay you, not what you're going to put in. Here's what's cool about that. You pick your target retirement income. So let's just say you're making or want to make in retirement, say $100,000. We'll keep the math easy. But maybe you're 50 years old now and your target retirement age is 60, right? So that's the other factor that comes into play is the target retirement age. We've only got 10 years to create a fund that's going to pay you $100,000 a year for the rest of your life, right? That's what a defined benefit plan is. So how much do you think we get to put in? Well, I don't know the answer to that. What happens is a plan administrator or an actuary actually calculates that contribution. Now that might sound pretty complex. I can tell you these used to be pretty complex. You can set one up at Charles Schwab for $1,200, right? This is easy stuff. And when you see this next taxed benefit, $1,200 is going to seem, oh my gosh, I can't believe it's that cheap. So they calculate this, but it's all based on your target retirement income, target retirement age. So you got some flexibility there. You can put a maximum of $210,000 per year per employee. So if it's you and your wife, holy cats, that's a lot of money you can put away. Now let's just think about that 40% rate we're saving. That means Uncle Sam, if you're putting away 210, Uncle Sam's paying $80,000 of that for you just in tax savings.
So that's
Now,
per employee. So like if my wife's an employee, I could put 200 for her in there as well.
right, right. And I'm going to talk about the
Okay.
defined benefit plans are simple, but there's a couple of things to watch out for actually. Let's talk about those. So, a couple of things you want to watch out for. The IRS says this is a permanent plan. Well, you can already see it on the slide. When the government says something's permanent, well, that means it can be changed, but you want to keep this plan around at least 5 years. Okay, you don't want to make significant changes. That being said, you need to also review your other businesses. So a defined benefit plan has to cover all eligible people. And there's some rules and regulations about that, but I'd be happy to walk you through some of that stuff to make sure this strategy fits for you. But if you have a business and your spouse has a business, your defined benefit plan is going to cover both of you. So if you have a bunch of employees in one of those, you need to maybe do some planning and strategizing so you don't have to cover all of the employees or only cover certain key employees. So you want to review your other businesses. But that being said, it's actually pretty flexible. So even in that 5-year period, you can change your mind, okay? And you can say, let me go back here. You can actually say, well, I want to change my retirement income. I want to change my retirement age. I want to make it longer. And that's going to either shrink what you can put in or increase what you can put in up to the limit. So if you say I want more money in a shorter period of time, you're going to be able to take a bigger tax deduction. If you want to say I want less money and I'm going to wait to retire, you're going to be able to make a smaller contribution. You just don't want to do that every year, okay? So really in a nutshell, your defined benefit plan is like any of your other retirement plans on steroids. You have to do a little bit of planning to get to where you want to be, but this may be right for you, it may not, but if it is, if you're making, gosh, 400,000 or $500,000 a year plus, and you want to really sock it away and have Uncle Sam pay you a bunch of money to do it, you want to save a bunch of those taxes, it's a strategy that's very, very simple to set up once you do the planning that you get a lot of bang for your buck. I mean, a lot of bang for your buck. I mean, that's huge. So if we recap, the bottom line is what you want. These are just a few of the tools. You want a strategy that works for your business. You want a strategy that's flexible, right? Because you want to be able to make modifications. Some years your income's going to be up, some years your income's going to be lower than that. It is what it is. But you want something that's flexible. So that's why, a tax strategy isn't one size fits all. And so many people, I think, and I say people, so many professionals in my profession try to say, hey, you know what? Hey, we'll do this, this, and this. A C Corp may or may not work for you. I think it's probably a tool that at your income level and your business level probably does work in conjunction with something else. The DB plan, maybe we need to grow into that a little bit, but there's some other retirement strategies we can use till we get there. The bottom line is you want a strategy that gives you freedom, right? We want to keep as much as we can, and with Carl and Scott, you're going to make as much as you can, and
Amen.
I want to help you, keep as much as you can. That's what it's all about.
Right on.
It's not what you make, so to speak, is
What you keep, no question. My father-in-law just told me that the other day, and I'm like, it's funny that you're on the call right now because I mean, you hear it all the time, and he's obviously done very well for himself. So it's nice to hear it from somebody else.
Yeah. And you know what? Those are the key strategies. So, um,
Some questions.
yeah, let's get to that. I'd like to,
And I know that
I want to
you,
make sure.
a ton of people are asking a ton of questions, and they're really good questions. A couple that I picked out, but I know that you have something to offer other people as far as a consultation, and I wanted to make sure that we fit that in before the end of the hour. Just so if people, I mean, because there's people going, "Hey, I had a C corp, haven't used it for 15 years. What income should I be at to start a C corp? I mean, there's so many. What age do my kids have to be to start paying them the
Perfect.
6,200? Those are some
Let's do
questions that I
this,
keep coming
Scott.
up with.
Let's
Yeah.
do this because
Okay.
this is very personalized. I can answer a lot of those questions in general.
Sure.
I'd like to share with everybody just something really straightforward. This isn't a sales
Sure.
pitch or anything like that. Let me just
Sure.
show you what I can offer you on an individual level real quickly, just to talk and create a strategy for you. I mean, that's basically it. Let me help you create your plan. That's what I have for you. And here's
Sweet.
how it works. It's super, super simple. And I'm going to go through this fast too.
Okay.
All you got to do is go to www. I don't even know if you need that anymore, right? That's old school. That's me.
Right.
Save50kintax.com/strategy.
Okay.
Save 50K in tax. That's what we've been talking about all day today. Go
All
to
right.
save50kintax.com.
And
So here's what
what's going to
happens.
happen when they go there? Yeah. Go ahead. Go
You
ahead.
go there and you fill out a little form. I have you leave a show up deposit. I used to do these free, and it was just a nightmare for my assistant to get people booked. I don't want your money. I'm telling you that right now. I just want it. Let's have a meaningful conversation. This deposit's totally refundable. Even if you just say, Vern, I don't like the tone of your voice, give me my money back. I don't care, okay? The
Right.
deposit is just there so I know you're serious. And here's what happens after you do that. You fill out the form, you leave your deposit. It's $500, right? It's not going to, and it's coming back to you. Carol, my assistant, over 14 years, she's going to call you to set up a time to talk. We're going to get on the phone. I'm going to learn more about your business. I'm going to learn more about your goals. I'm going to learn where you are now and where you want to be, right?
Right on.
And then we're going to create a strategy right there on the phone that probably works for you, right? It will work for you, whether that's the C Corp or that in conjunction. I mean, these are just two strategies. I mean, this
Right.
two great tools in my toolbox, but we're going to create a strategy that's flexible that works for you. And then the strategy is going to be tailored. You can implement it easily. I guarantee it'll save you thousands of dollars, and it's going to help you get the freedom. Now,
Now
here's
here's
what's going to
the.
happen.
Okay. Go ahead.
After we create
Cool.
that plan,
Go ahead, man.
oh,
No, go
I'm
ahead.
just going to say, here's what'll happen. I mean, you're either going to love it and you're going to say, hey, I've got a CPA. I'm really happy with him. I'm going to have him implement it with me. No worries. I'm going to refund your $500 and I'm going to wish you good luck. We may just decide this doesn't happen. Actually, I don't think it's ever happened. Somebody says, hey, we're just not a good fit. I'm going to give you your money back and I'm going to wish you good luck and go on down the road. And or what usually happens is a lot of people say, look, I love the plan. Can you help me with this? My CPA didn't create anything for me. They haven't been strategizing with me. Can you implement it with me? And then if that case, you become a client. Basically what that is you've just hired your financial quarterback. We implement all the strategies in the plan. We take care of all of that. We prepare all your income tax forms, your personal, all of that stuff, so you don't have to worry about it. Here's what's different. We talk every single month, whether it's 15 minutes or 30 minutes, or maybe you need an hour. I don't know. But we consult monthly to make sure that not only your tax strategy plan, but your business is on track. I mean, think about this as a supplement to what Scott and Carl are doing. They're telling you what to do, and I'm saying, hey, you haven't done that yet, right? You said you were going to do it. Our income's supposed to be here. What do we need to do? Boom. So it's kind of a supplement to that. So that's the difference. Is I'm not a once a year kind of guy for you. I'm your quarterback. I'm there every step of the way. And basically, we handle all of this, so you can focus on what you're supposed to be focusing on is the income. So
Cool,
save
man.
50kintax.com,
I'm going there.
and that's easy. It's easy.
Hey, so my question: does it matter if you're W-2? Do you have to be self-employed?
Self-employed, it works a lot better.
Okay.
Obviously, there's no reason. There's really no reason for a W-2 employee to have a C corp. Now,
Okay.
there's other strategies we can implement. Now, some people, especially in the mortgage industry, since the whole meltdown that I
Yeah.
know everybody's been through, but
I don't know what you're talking
um,
about, man.
a lot of them are statutory employees, which means they get a W-2, but they report that income on Schedule C.
Okay.
There's a
Yep.
lot of stuff we can do for those guys because we can still take expenses against that W-2 income on our Schedule C, and we can shift some of that out using a C Corp strategy. So statutory employees we can do a lot of stuff with. Regular
Okay.
employees, I'll visit with you and come up with some other strategies. I'll be straight with you though; they're just not nearly as sexy as what we talked about today.
Okay, and can you service all states? I know you before we got on the call with nobody heard this, but you're helping you have clients from like from Maine to California, correct?
All over. My main
All over.
practice years ago was in Colorado, and I had clients in probably 30 different states,
Okay.
from New York to Florida to California to Washington, and it's the same now. I'm out in California, that's my physical location, but I have
Okay.
clients all over, and I can service any state.
Okay. So it doesn't matter. Okay, cool. So it's not the matter of fact that you don't have to be licensed in a state to help somebody.
Right, right.
Okay. So Beth says, "Who do I hire who knows about all these things?" And while you're talking to him on the phone, which is the best thing in the world. So whether here's the thing, and just to make this very clear with everybody on the phone, if the $500 for this save 50k in tax.com/strategy, it's not $500 that you're not going to get back. This is to save your spot. And dude, I'm totally with you. When I book appointments and people don't show, money makes them show up. So that's just to show up to an appointment with Vern, just so he's not booking appointments that he could be on with other clients that want either a strategy or time with him. So that's all that
So
is.
yeah,
100%
here's
of the time
here's
you
where
get
I'm
to
at
meet
with
with him.
that.
Yeah.
I don't want your $500.
Right.
If I cannot add value and save you a ton of money, bottom line is I don't want your money. That's just not how I operate. If I can't save you money and help you keep a lot of money, I don't want it. So,
Right.
um, fully refundable. Don't worry about that. What I
Here's
would like to do, I know there's a ton of questions. Start hammering me so we can
Yeah.
get as many
So the
questions
biggest
answered as
question is,
possible.
at what income level should I talk to somebody like you? Like,
Okay, so
I like the
it really
go-getters.
varies depending on your strategy. I mean, you can see that, once you get over the 100 to 150,000, depending on if you're single or married filing joint, you're already into a 25% tax bracket.
Okay.
So, anytime you can take some of that and move that into a 15% tax bracket or work out another, whether it's a retirement
It's huge.
plan strategy or something like that, um, anytime I think you're making over, say, a buck 50,
Uh huh.
uh, you can start saving a ton of money in tax.
Okay.
And you can do it before then. It's just you get less bang for your buck. But if you're growing your business fast,
Yeah.
let's get started.
Okay, and the kid thing, like a ton of people had. How old do my kids have to be to pay my? I love that idea as well because I have two that are one's 17, one's going to be 19. How old do they have to be, and how old can I pay them? I mean, how old? I mean, how far can that go? Because that's
You
it. I
can you
mean,
can pay them till they're 80 years old if
okay, okay, all right,
if you
all right,
want to, right?
okay,
And as you grow your business, if they become part of that business, obviously that's a
huge.
partnership or
Yeah,
salary or whatever. But I feel comfortable paying kids as young as 5, as long as we document and justify truly what they're doing. A lot of the younger kids, like the 5 to say 10-year-olds, if we can use them in marketing or something like that with a little other twist rather than saying they're working 10 hours a week cleaning the office.
licking envelopes or
uh,
something like that. I mean, there's a
yeah,
lot. I mean, you
yeah.
can do that at
But if
5
we
years
do a lot of
old.
mailings and stuff like that,
Yeah,
we can show that, hey, they're doing it. We
yeah.
want to be able to justify it, and we want to be able to document it.
Okay.
IRS is all about documentation.
Here's a great
So
one
I'm
by
super
Debbie.
comfortable 5 or older. Once they
Okay.
get around the 10-year-old range up, all their
Easy,
teen years, high
easy.
school, no
Yeah.
brainer.
Okay, so here's a good one by Debbie. If someone already retired and has real estate rental income, would you recommend a C corp?
So it all depends on what your income level is. And here's why a personal call really helps, because Debbie, I might be answering this question thinking you have $50,000 worth of passive rental income coming in and you have 500. If you have 500, all that's going to flow through. It's not subject to self-employment tax, as rental income is not self-employment income, but it is at the higher tax bracket. So maybe it does make sense to have
If you have
a
a bunch
separate set
coming
of
in, yeah,
brackets at the
got
higher
it,
levels. So
got it.
my answer, Debbie, is maybe, depending on your income level. But anytime your income gets into and non-W2 income gets into that upper level where you want another bracket, a C corp may make sense for you.
Ton of people saying great info, love it. The name of your book. A couple people asked, what was the name of your book again that you wrote?
It's called Keep Your Money,
Keep Your Money.
and the
Okay,
subtitle is How to Save $5,000 to $50,000 in taxes each year.
okay. Beautiful, beautiful. All right. In a C corp, are you able to be employees, or this is probably maybe a question for the conversation, but in a C corp, are you able to be employees, or do you remain an independent contractor?
Oh, well, I'm not quite sure if I understand the question. So your C Corp is going to be an independent contractor of your other business. You
Okay,
would pay yourself a small salary out of that. So you would be an employee of the C Corp,
got it.
but you would be an independent contractor. You know,
Got
that
it.
brings up a strategy, Scott, that a lot of people, and statutorily, some people can't do this, but a lot of people say, hey, I'm an employee for this guy, but, maybe I just handle all their bookkeeping or I handle all their marketing. They're paying me a W-2.
Yep.
It's a benefit to them and it can be a benefit to you to have them pay you on a contract basis. So if you have that opportunity to where you can save a bunch more in taxes by using these strategies and get paid contract, do it. It benefits your employer. It benefits for you. Some people that's not uh, possible, but for some people, if it is, I'd go for it.
Okay, Kristen, appreciate the question. Are you saying that we should set up both an S and a C corp together, or just a C corp?
I like using both of them together.
Okay,
And the reason is typically as you grow your business, a lot of people start with that S or that sole proprietorship, just like we talked about. Not a bad thing. It's just their stepping stone. It's easy and they haven't made any money, and then they graduate from that to an S corp, and then they run their S corp, and now they're starting to feel the crunch of taxes because they now their income's so much higher, and then boom, now it's time to add another piece to it. So I
right on.
like using them in conjunction. You can use them by themselves without a doubt, but I like using two of them together.
Cool. Ken, this is the one from Ken. It's a good question. I've had a C corp for 15 years, but I have ignored it. What does it cost me to reactivate, or is that what he should do?
Okay, a lot of times it just depends, but a couple of factors. If you filed tax returns for it, even if they've been zero or kept them up with the Secretary of State, then we could probably use it. Sometimes it's so cheap to set up a company anymore that sometimes it's just best to cut
Yeah,
the
didn't you say a hundred
baggage,
bucks?
let it go.
Yeah.
Yeah, well, forgive me, it's $100 a year, but you can set the corp up for a couple $100 in Wyoming.
Okay.
So, I mean,
Could I mean me being in
I'm
Michigan?
thinking
Me being in Michigan, can I set my C corp up through Wyoming?
absolutely, and you
Okay.
should, because
Okay. All right.
Michigan has a state income tax,
Okay.
and everything that runs through your Wyoming corporation is not subject to Michigan
And they
taxes.
don't have a problem with me doing never being step foot in Wyoming.
No, as a matter of fact, they offer a service just like Nevada does, where they take care of that for you as far as having your office there and all of that.
All right.
Super cool.
Yeah, that
I mean,
is that dude.
it's
Yeah,
amazing.
I can't even imagine. I wish that I could take everybody on this call and like that took something from this class today and put the money total of how much you're going to save us total. Isn't that? I mean, we had
Well, I'd like that
five,
too.
six.
That'd be
Wouldn't that be
super fun to
cool? Wouldn't
see.
that be cool? Um,
Absolutely.
I'm gonna see. Okay, good, good, good. Hey, Karen, did you see any other questions that I didn't ask that might be a good one? Okay, here's one. If you own your own restaurant in Massachusetts, is it still possible to have set up a C corp in Wyoming? Which I already answered that question. So yes, that's a yes. Is
Yeah,
Delaware
absolutely. With your restaurant, you just have to decide what am I going to shift over?
right?
What income?
Thanks, great info. I'll be setting up a call. Got to run at an appointment. Thanks, Paz. Appreciate that. What about Nevada? That's a see. Does it matter when the year of the? Yeah, that's a good question. Does it matter when in the year the C corp is established? Do you get the benefit of the entire year
Um,
regardless of when it's established? Great question.
yeah, actually, for our purposes, you do. So let's just say we set one up May 1st and we had a November 30th year end. So we'd file what's called a short year tax return because we didn't have a full 12 months.
Yep.
So our first tax return would only be from May 1st to November 30th. So setting them up now and shifting that income over and getting that established, um, you save more taxes before the end of the year than you ever do after the end of the year. So the thing is planning and strategizing. That's what's important. So I would get going with it now.
Cool. And do you work with the financial planners? Like say that somebody's asking, so I have a financial planner. Would you work closely with him because I might be doing some stuff with him, and I got this going, so I got a lot of different stuff going. Would that is that some is that something you would do?
Yeah, absolutely. And you know, in my practice, I also sometimes, I don't do it very often anymore, but I used to do it a lot. I actually work with somebody else's CPA.
Okay. All
I'm
right.
I'm part of the team. I usually quarterback it. I'm the guy that, you know, I'm your go-to guy, and then we talk to the attorneys, the financial planners, maybe another accountant to say, hey, here's what we're doing and strategizing, and here's the plan, and I'm going to help implement it and keep you on track that way. So we
Sweet.
want to work with as many people that we have to accomplish your goals. That's important.
Awesome. And man, I appreciate that about you. So a lot of you guys are asking questions about if I make this much money. Here's the deal, guys. It's $500 only to show up. You get 100% of your money back. He's not going to hold $1 for it. The reason and if if you think you have a reason to talk to him, that's what he's here for, and he can answer all these questions. So by all means, I'm not trying to sell you anything or do anything. It's just that it's a great way to have a personal, because we're asking, he's answering generic questions. It's hard to narrow down exactly what's going to be best for you, and if you should or if you shouldn't, or if you should do this or do that, or what strategy. He might even come up with a different strategy that's special for you and your situation. So by all means, take him up on that call, which I'm going to do for sure. And man, dude, you've given me so. I mean, you know what's funny is my wife is like, we got to find a way. There's got to be ways out there to not pay the taxes. So I couldn't have come in a better time for me. I mean, seriously. So I appreciate you, and a lot of other people are saying great stuff, great content. So I appreciate you being here.
Awesome. I'm glad I could help.
Here's a great question by David. And this will end with this question. Do any of these strategies cause a higher risk of being audited?
No, here's I should say it depends, I guess, on
Right,
what you
right,
do.
right.
Anytime you do something wrong, it causes a chance for being examined. We call it, everybody calls it an audit. It's an examination is the lingo we use. So out of all the clients I've served, thousands of clients I've served, I've had two full examinations in my entire 18-year career.
Wow,
And
good
I'm not
stuff.
being boastful about that.
Right.
What I'm saying is I create strategies that work and that are justified. And so if the IRS ever sends you a letter, we say, boom, here it is. Here's what we got.
Very cool.
Here's why we did it. And here's a code section that justifies our position.
Right on.
I just had a client the other day send me a huge letter from a state that wanted to tax him on all his income. And we wrote a letter to them, backed everything up, and told them, look, you've got no position to be sending us this notice. It was gone, over. They sent him a
Wow.
letter a week later, case closed on this.
Very nice. Very nice.
So you do things right, and you're not going to increase your exposure of examination. How's that? That's what we
That
call it.
dude,
Whoever asked that question,
no, that's awesome. That's
exposure of
awesome.
examination.
Hey, to end this call, Vern Motor. So, if thanks for so much for joining us. I sincerely look forward to. I'm going to book a call with you, and I can't wait because I want to take advantage of all this stuff. And so, if you're joining us for the first time, if you want, join us. We have about 4,500 and growing on a daily basis at facebook.com/groups/agent mastermind. And if everybody left, if you could just give Vern a couple nice words on our Facebook group, that'd be greatly appreciated. And Vern and I'll get you hooked up with the Facebook group and get you in there. And I'm sure they might have questions for you in there, but that might just allow a couple more people to set up because this the recording will be up by tomorrow along with the PowerPoint. So if for some reason you want to rewatch this or go over the strategies again, I would just personally book the call with Vern. But that's totally up to you. So appreciate you being here, brother. Thank you so much for your expertise. And man, I don't know if it's strategist is a good word, but I'd put ninja in front of it. Ninja
Thank you.
strategist for taxes. So it's really good stuff. Look forward to getting to know you better too as well. And I really appreciate you being part of the group, man.
Awesome. Well, thank you so much, and I'll post in your group once you add me to it as well.
Absolutely, absolutely. So facebook.com/groups/agent mastermind. Okay, for everybody left on the call, next week, don't miss it. We're going to be showing the flower pot strategy that everybody's talking about. You don't want to miss it. Going to be a good time, going to be a full house. So get there early. Look forward to seeing you there. And Vern, thanks so much again. I appreciate you, brother. Talk to you soon. Everybody, have
All
a great
right, great.
week. Be safe, and we'll see you right here, same place, same time next week on Agent Mastermind. Take care, everybody.